This episode of The Benefit Whisperer is brought to you by Route 3 Insurance and Financial Services, where smarter benefits begin. If you're tired of rising healthcare costs and opaque insurance contracts, Route 3 is here to help you take control. They specialize in transparent, employer-driven benefit strategies that protect your people and your bottom line. Ready to break away from the status quo? Visit www.fixmybenefitsnow.com and discover how Route 3 can help you build a plan that actually works for your team and for your budget. Welcome to The Benefit Whisperer, the show where we pull back the curtain on what's really driving your healthcare costs and what you can do to stop feeding a system that's rigged against you. I'm Ralph Weber, and today we're talking about something that every employer and every broker and consultant needs to understand if they're serious about escaping the PPO hamster wheel and just the status quo, fully insured, et cetera, et cetera. And that is captives. We hear about them all the time. What are they? How do they work? And why more forward-thinking employers are using them to break free of the traditional insurance traps. Now, let me add this. As with anything in life, there are good captives and bad captives. Some might make sense for you and others don't. Every employer is different. So be careful. And before somebody just says, hey, we've got to use a captive because it's the buzzword, make sure you look into it a little bit deeper. So I'm joined today by Phil Holowka, Chief Operating Officer and at Complete Captive Management Services with over 20 years of experience in finance and risk strategy. Phil helps employers take back control of their healthcare spend by designing and managing group captives that actually work for their business, not for the insurance carriers. Phil, thanks for being here today. Can you tell the listeners a little bit about your background and how you got to be in this space?
Yeah, Ralph, thanks for having me. I'm delighted to be on the show with you today. So I got into this space through a very unique roadmap. In my prior life, I was a paramedic for many, many years.
Wow.
And being a paramedic, it's a fun and an exciting opportunity to help the public. However, it's really a young man or woman's game. And as I was not becoming a young man anymore, I figured out I needed something else to do with my life. So I got into employee benefits and I started an ambulance association. So my route to get here today as the captive manager has been riddled with potholes, so to speak, but with any good goal, you got to overcome the obstacles, and here I am today.
That's great. And it's interesting because my story is kind of parallel, similar. Okay. I was an air traffic controller.
Oh my goodness, I never knew that.
Yeah, which is also a young man's game. But, you know, the cool thing, Phil, is that as an air traffic controller, you've got like potentially sometimes 50, even more aircraft in your control zone. They are at altitudes between 0 and 55,000 feet, flying all different speeds, all different directions. You've got wind speed coming out of different directions at different altitudes. They're climbing, they're descending. Most of them are blinded in clouds. So keeping them all apart and getting them as quickly to their destination is really important in air traffic control, and you can't make mistakes.
So Ralph, it almost sounds like you and I have a common bond in that
Exactly.
We are able to manage chaos, and that's something that I've been always proud of.
Absolutely. No, you're absolutely right, Phil. And, you know, of course, in air traffic control, you can't use the old Orville Redenbacher, 99.44%, because that means
that's right.
Bad things happen. It has to be 100%. So anyway, fun fact. Okay. Yeah. So let's start with some of the basics. So what exactly is a captive in the context of employee benefits, and how is it different from traditional insurance or traditional self-funding?
Well, let's make it easy. Why don't we start from the beginning? A captive insurance company, by definition, is a private insurance company. So what that means is the insured business has to be related to, in some capacity, to the captive that they are involved with. Now, out there today, you're going to hear at social media, captive this and captive that. There are so many types of captives out there that are being promoted, but in reality, there's really only two types. There is a group captive, and then there's a single parent captive. That's it. Mm-hmm. The magic really cuts with those two structures. So the the captive itself is not a new structure. It's still a regulated insurance company.
Mhm.
So I like to joke and say the captive that we manage is regulated by the same gal or guy who also regulates the big insurance companies that everyone knows out
Okay.
there. So it is highly regulated. And just because you're a captive, you don't get a free pass by any means.
Right, right. That's good to know that there's that protection and oversight.
Yep.
So this might be an oversimplification, but is there a specific type of employer that might be a good fit for a captive and who's not a good fit?
So I look at that as the common bond. What is the common bond of captive participation? And really that common bond is, are that employer willing to take control of certain elements that they thought were not controllable? So a sophisticated employer, whether that be a CEO or a CFO, will look at this opportunity and say, no, wait a minute. I control every attribute of my business, yet I can't control the health plan spend. Why is that? So that's the first step. When
Interesting control.
that
Mhm.
executive says, why can't I, aka have control of something that I don't feel like I have any control of, that's the first step. So that's the common bond.
Okay.
So if you want to look on the other side, who's not a good fit, well, that employer that simply feels that they can't control something. So it's really a contribution sport. You have to get your hands dirty in order for you to realize the features and the benefits of a captive.
Right. That's good. You know, and I think a lot of employers out there feel that they can't control their healthcare expenses. So this is a tool to help them to control those.
Well, it's a propaganda machine, man. Every employee on, a public bus or driving down the road, they see on the billboard, Blue Cross, Aetna, Cigna. There's big dollars at the propaganda machine to think that in order to have good insurance, you have to have, aka like a Blue Cross card.
Right.
That's not,
Right.
in fact, that's not at all the reason.
Yeah. No, absolutely. Absolutely. Just because they're big and well known doesn't necessarily mean they're the
Absolutely.
best solution for any given employer.
Yep.
Okay, so most employers assume that captives are just for gigantic corporations, and I'm sure you don't agree. I don't agree. So what's the minimum size or funding level that makes where it makes sense to consider one?
Well, this is kind of a two-part answer. Within the market, as I mentioned before, there are two types. There's group captives and then there's single parent captives. The belief, and it's a firm belief, that a group captive is really good for 20 to 500 employees, somewhere in
Okay,
that area. Then the single parent captive, that is a much bigger misconception out there. We are the managers of a single parent captive structure, and frankly, we can write down to 20 covered lives. But thinking about that, if you have 20 covered lives, sometimes the barrier to a single parent captive is sophistication. Because when you
right,
join a group captive, I like to say there's a kumbaya effect where
right,
the employer joins this and they have safety in numbers, so to speak. But there's a cost to that also. A single parent captive is when the employer is hyper focused on striving to do cost controls and do cost mitigation strategies, because at the end of the day, it's their insurance company.
That's interesting. So in essence, what you're saying is they are the shareholder of their own insurance company with a single parent captive.
That's right.
Is that not the case with a group captive?
Well, a group captive by definition is there's no majority shareholder, right?
Oh, okay.
And a group captive, you'll have 100, 200, 500 employers, whatever it is.
Mhm.
They may or may not have ownership equity stake in that group captive facility. So you have to ask the right questions. And that's really
Mm,
important to me as a captive manager because
sure.
there's so much buzz out there about captives.
Yeah.
Employers are not asking the right questions. Okay.
Makes
On a
sense.
single parent captive, the insured business is the sole owner of their insurance company. They are 100% owner. So that there are favorable attributes to that structure, accounting, tax,
Right.
lots of things that you just can't get with a group captive.
Interesting. So, let me ask you a question. Is a group captive owned by a stop loss or reinsurance carrier, generally speaking? Always, sometimes?
Well, when you've seen one captive, you've seen one captive.
I see.
And
Gotcha.
the ownership, smoke and mirrors, can sometimes be opaque to an insured that doesn't ask the right questions.
Right.
Because let me just paint the picture for you. Governance and control are not the same. Okay. So when you're in a group captive, that group captive may be owned by a third party and you're going to get limited governance, but you're
Right.
never going to have control.
Makes sense.
Control means discharging or firing the captive manager or any other service provider that
Sure.
runs the captive.
Yeah.
So the ownership is really, really important. And in a group captive, you do a lot of times get the captive that's owned by a carrier. Well, riddle me this. Why would a carrier own a captive? If I were a shareholder of that commercial insurance company, I don't want my profits to be diluted, right? So why is that?
Okay.
And if a group captive is owned by a brokerage firm, why is that? So you just have to ask the tough questions that sometimes people don't know how to ask.
Wow. Those are good questions. So what's the advantage of a group captive over a fully insured plan? Or, is it just about cost savings or is there more to it?
I think it's the crawl, walk, run approach. Right? A group captive is good. I'm not going to discount a group captive by any stretch. However, for an employer that may not have the full understanding or the sophistication level of what it means, the differences, and how to value them, entrance into a group captive is still better than simply going out to the commercial market to buy fully insured coverage.
Makes sense. So being part of a captive, does it give employers more control over their plan design, their claims, their renewals?
So I would say the statement of participating in a captive gives you more control is not necessarily true because that's really a self-funded attribute.
Makes
So
sense. Yeah.
participation in a captive makes the employer smarter.
Right.
That's
Right.
what happens.
Okay.
So when you're smarter, you get to ask different questions.
Right.
So that's the value of a captive participation.
Okay. Now, talking about single parent versus group, let's say an association of like-minded businesses wanted to get together. Can they still do that in a single parent captive?
Yes. So what would happen is every employer within that association would form their own single parent captive. And just think of it like a hotel room concept. The single parent captive is a hotel room. The hotel itself is what's called the risk pool because every single parent captive has solvency risk because if you pay $100 of premium and you have $200 of claims, well, now you're technically insolvent, right? So what happens is to solve for that solvency risk is you have to participate in a risk pool with other single parent captives.
I see. Okay. So there's some degree of sharing of risk.
Absolutely. You have to have that sharing, risk shifting, and risk distributions in order for the employer to deduct the stop loss premiums that they pay into their captive.
Oh, now you mentioned something that might, scare some people. You talked about if there's $100 in premium and $200 of claims. What happens if whatever the ceiling is of the captive, what happens if your claims go above that?
So the risk shifting and distribution functions no differently than what a business owner is in today. Because in reality, if you're buying coverage from Blue Cross or Aetna or Cigna, you're just in the Cigna captive. There's no difference. Okay. So in this model, if you give me 10 captives, 10 single parent captives, I will tell you today that 2 of those captives are going to be what we call losers. They're going to pay $100. They're going to have $200 in claims. Okay. The other 6 are what we're going to be called in the money. They're going to pay $100. They're going to have $60 in claims. Some will have 40. Some will have 20. And then the other 2 captives are not going to have any claims. So the 8 captives are going to subsidize the 2 captives. And that's just how insurance works. Right.
That makes sense.
When your single parent captive participates in a risk pool, all you're doing is you're subsidizing your losses across the other captives that are profitable.
That makes a lot of sense. So now everybody's talking about transparency of data. What can an employer expect in a captive arrangement compared to traditional fully insured carrier or traditional self-insured?
So transparency is a buzzword, yes, that's going on, but it's abused at the moment.
Yeah,
It's
totally.
not fully used correctly. Let me explain. So when you're in a group reinsurance captive, that means there's a fronting carrier involved. And when there's a fronting carrier involved, when the insured business is paying premium, that premium is paid to the fronting carrier, the admitted insurance company.
Mm-hmm.
And when an insured has a stop loss claim, the fronting carrier is paying that claim with the captive's money. Okay. Now, I'm not going to be a conspiracy theorist, but just ask yourself this question. If the carrier is paying a claim with someone else's money, is the same level of scrutiny in that claim given to the captive member? In other words, Ralph, if I give you my checkbook and I say I need you to buy me a refrigerator, you're not going to scrutinize that purchase as I will. The beauty with a single parent captive with no fronting carrier is we have control of the checkbook. The insured business says, wait a minute, that $100,000 claim doesn't smell right. I think it's overbilled. I think there's duplicates. I think there's errors in it. I think it should be 40 grand. Well, we as the captive manager dig into that much more efficiently and much more attuned to billing errors than I would suggest that a fronting carrier does.
Sure. That makes perfect sense. You know, I always talk about Milton Friedman, and he once said, I don't know if I've ever told you this, he said there are two kinds of money. There's your money and there's my money.
That's right.
And there's four ways to spend money. Me spending my own money, you spending your own money, you spending my money, and me spending your money. I think that really describes a lot about insurance. When you are paying an insurance company premiums, whether it's for stop loss or a fully insured plan, you're spending their money.
Yep.
Okay. And they're protecting their money, right?
Yep.
So they might deny some claims that should have been paid. Whereas when you're spending your own money, as you said, you're going to scrutinize which ones shouldn't be, but you're also going to say, wait, this makes perfect sense to pay this. Is that a good, fair analogy?
I think so. I think when people are more in tuned with how the money is spent, AKA being smarter about trying to control your spend, that makes for the perfect recipient to own your own insurance company.
Yeah, absolutely. Yeah.
I mean, to me, it's like, why am I the only person thinking of this?
Exactly. No, I hear the coin drop. This makes perfect sense.
Yeah.
Okay, so let's talk to some of the myths and misconceptions. Yeah. So sometimes captives get a bad rap for being too complex or too risky. What do you say to employers or advisors that kind of hesitate because of this?
I think it's in large part ignorance. Consultant that is open-minded and has the ability to make choice on which captive to use without sales director pressures or broker dealer pressures, right? So there's a lot of that in there too. But I struggle with this, Ralph, because even though I'm in it day to day, you give me any CFO who understands ebbs and flows of debits and credits and taxation and all of the other things needed to run their business.
Right.
Man, they get this in the New York Minute. They really do. So when a consultant comes to me and says, "Oh, Phil, I'm very cautious about this. I think captives are too complex for my client," they're really selling their client down the river for being a nitwit, right? Yeah. It's not, man. Mm-hmm. So it's just a simple financial exercise.
Right. And what are the biggest misconceptions you run into when you're talking to CFO or CHRO, CEO, leaders about captives?
Well, the one legitimate question that is always surfacing is solvency, right? So within the world of stop loss and any other insurance company, there's a rating agency out there. A rating agency gives the buyer comfort that a third party evaluated the financial statements of that insurance company. And a captive that has full transparency, but even more so in a single parent captive, a rating agency doesn't mean anything because the policyholder is also the shareholder. So the two are symbiotic in that the policyholder has firsthand carnal knowledge about their financial statements, as well as the financial statements of other captives in the risk pool. Right. So the concern that CFOs always say is, what happens if you have an insolvent moment and my claims don't get paid? Well, the fact is we are so highly regulated by Nevada, which is where our flagship captive is. We give Nevada our quarterly unaudited financial statements, and we do an annual financial audit. And if Nevada sniffed out an insolvency, they would shut us down instantly. And within the world of insurance, it's not about, hey, look at us, we collect $1 billion of premium, so we're like strong. No, that's not how it works. It's all about ratios, right, Ralph?
Yeah,
you know this.
Of course. Yes, absolutely. Yep.
So.
Yep. Interesting. So tell me, Phil, are there any red flags that an employer should watch for and look for when they're evaluating different captive programs or captive managers?
Yeah, man, I have a whole list. So as a captive manager, there are red flags involved with the promotion of group captives. The biggest thing you need to be inquiring is, number one, control. If the employer is looking to gain control within their captive insurance company, if they can't fire the captive manager or the captive program manager, you have no control. Done. Number one. Number two, I can provide any consultant a list of all of the questions that they need to ask the captive program manager or the captive manager. Legitimate questions. If you don't get those questions returned to your satisfaction, that's a red flag. The third thing is expense load. I will tell you with the utmost confidence that if the insured, the business, goes to the commercial market and wants to buy a $100,000 stop loss policy, that policy is going to be more expensive with a group captive. Why is that? Well, it's because the admitted carrier has their own expenses, right? Big insurance company has to pay for the electric in their building, the rent, the property taxes, everything, all the salaries. That's called expense load. The average commercial insurance company has an expense load in the 20, 25, 30% range. Captive also has its own administrative expense, 10, 15%. So when you smash those together, you have an expense load that's 35, 40, 45%. So in other words, when you join a group captive and you give that captive $1, you're only getting 65 or 70 cents worth of benefit. In a single parent captive, like what we promote, where we don't have a fronting carrier, our expense load is 11, 12, 13%.
That's a big difference.
It is. So would you rather pay $1 and get 65 cents of benefit, or pay $1 and get 85 cents worth of benefit? I mean, it's really a no-brainer in my mind.
Yeah. Now, I know that there is a difference between, we're talking about 831Bs in general, as a structure. And we know that there's a difference between an A and a B. Now, tell me, does that mean like 831A as opposed to 831B, or what does that mean, A versus B?
So the 831 Internal Revenue Code section of our tax code, there are two subsections. There's 831A and 831B.
Okay.
The 831A is the default election, and it's basically the captive is a C Corp taxpayer. Okay. So in other words, if the captive collects $1 billion of revenue and they have $100 million of profit at the end of the year, well, they're paying 21% income tax. Right. So now that boils down to $79 million. The 831B election allows a micro captive to not pay income tax. So it's a bit of a tax efficiency option. Now, it's an option to elect A or B, but to qualify for the 831B, captive has to collect less than a certain level of annualized premium. Now, that threshold is indexed to inflation, but it allows a captive to not pay income tax, which becomes a motivation for the employer to actively get involved in the cost of treatments, right? To actively mitigate the risk, because the risk return is higher with an 831B captive than with an 831A.
Now, you said that there's an income limit. So does that mean that if somebody says, hey, I've got a captive with $1 billion, it's much more stable, that might be above the income level, and that may be a red flag that they're an A captive with higher expense, taxes, etc.
Yeah. So the 31A election is for any captive that really collects, north of $3 million of policy premium every single year.
Okay. So that's kind of a magic number. Gotcha.
Yep.
Phil, thank you so much for breaking down the captive model and showing employers and brokers, consultants, that there is a smarter way to finance healthcare without playing by the carrier's rules. But before we sign off, if listeners want to know more about the complete captive solution or take a deeper dive into alternate risk strategies, where should they start?
Well, you can start on our website, completecaptive.com. You can find me on LinkedIn. You can go to Complete Captive on LinkedIn or simply type in my name and I'll be right there in front of you.
Excellent. Great. So to everyone listening, overpaying for healthcare isn't just frustrating, it's optional. Captives offer one way out of the rigged game if you're willing to ask different questions and demand real transparency. I'm Ralph Weber, the Benefit Whisperer, and if today's conversation sparked a new idea or gave you something you can act on, please share it with a colleague, a friend, subscribe, like, and reach out at any time if you want to talk to me, Ralph at thebenefitwhisperer.com, or visit www.fixmybenefitsnow.com. Let's keep pulling back the curtain because the system won't fix itself. Actually, it will fix itself. Sorry. So that's kind of double meaning. Anyway, thanks again for being here today, Phil. And I'd like to have you back on another, I think we've got more to talk about.
Sounds good to me.
Okay. See you.
Thanks.
You.